Hello everyone. Welcome to the Stock Minds web channel. Affirm Holdings, NASDAQ, AFRM, a leader in the buy now pay later BNPL sector, has demonstrated impressive growth and financial improvement in its Q3 full year 2025 earnings report. With a significant increase in revenue and a notable turnaround in earnings per share, Affirm's performance indicates a robust trajectory. In this video, we will dive into Affirm recent earnings, stock performance and valuation, growth potential, and the risks investors should consider. About Affirm Holdings. Founded in 2012 by Max Levchin, co-founder of PayPal, Affirm Holdings is a financial technology company specializing in BNPL services. Headquartered in San Francisco, California, Affirm offers consumers flexible payment solutions, allowing them to split purchases into manageable installments. The company partners with over 358,000 merchants and serves more than 22 million users across the United States, Canada, and the United Kingdom. Affirm financial performance. In Q3 full year 2025, ending in March 2025, Affirm reported revenue of $783.14 million, a 35.92% increase from $576.16 million in Q3 full year 2024. The company achieved a positive EPS of 1 cent, a significant improvement from the minus 43 cents, increased 102.33% year over year. On a trailing 12 months TTM basis, revenue reached $3 billion, up 42.55% year over year from $2.11 billion, while EPS improved from minus $2.22 to minus 19 cents, a 91.44% reduction in net loss. Free cash flow per share TTM increased 97.91% from 91 cents to $1.90, indicating enhanced operational efficiency. Affirm's gross profit margin stands at 45.44%, with a net profit margin of minus 2.07% and a free cash flow margin of 20.24%. Return on assets is minus 1.38%, and return on equity is minus 2.26%, which are still negative because Affirm is not yet profitable, but it is beginning to move toward profitability. Over the past 5 years, Affirm has been able to grow its revenue at 51.9% CAGR, net income still negative but decreased significantly in 2025 and could become profitable in 2026, while free cash flow already positive in 2024 and continue to grow until now. Affirm 2025 financial forecast. Looking ahead, analysts project Affirm to continue the growth, with forecasted revenue of $3.18 billion for full year 2025, a 37% increase from full year 2024 $2.32 billion. Non-GAAP EPS is projected at $2.13, a substantial rise from the previous year's minus $1.65. The average analyst price target is $66.53 with strong buy rating, suggesting a potential upside of 28.66% from current levels. AFRM stock price performance and valuation. At the time this video is created, Affirm's stock is trading at $51.71 per share, marking a 56.5% increase over the past year, outperforming the S&P 500's 12.2% gain in the same period. However, since its IPO in January 2021, the stock is down 55.8%, underperforming the S&P 500's 58.3% rise. This is because the stock is overvalued at IPO. In terms of valuation, Affirm's current price-to-sales PS ratio is 5.59, with a forward PS of 5.33. The non-GAAP forward price-to-earnings PE ratio stands at 24.64, while the price-to-free cash flow PFCF ratio is 27.4. Based on FinChat data, if we look at the forward PS ratio since 2022, the current ratio is in line with the average, which is a good sign, and Affirm's business is still growing rapidly. Despite past volatility, Affirm is reasonably valued given its growth prospects and improving financials. Affirm growth potential. Affirm's growth trajectory is supported by several factors. 1. Repeat customer ecosystem and brand loyalty. Affirm's customer retention metrics signal a structural advantage. With 94% of transactions from repeat users, the company has cultivated a sticky user base that generates predictable revenue streams. This loyalty is reinforced by the Affirm card, which saw increased adoption in Q3, particularly among prime and super prime borrowers attracted to 0% APR offers. CEO Max Levchin emphasized that these borrowers often transition to cardholders, enhancing lifetime value through cross-selling opportunities. The company's everyday spending strategy, exemplified by the World Market collaboration, diversifies gross merchandise value (GMV) beyond discretionary categories like electronics. Affirm's virtual card integration with Apple Pay and Google Pay further embeds its services into daily consumer transactions, driving incremental GMV growth. 2. Product innovation and merchant partnerships. Affirm continues to innovate beyond traditional buy now pay later (BNPL) offerings. Its Debit Plus product, which combines checking account features with rewards, and B2B tools for merchants, are gaining traction. These products deepen engagement with existing users while attracting new demographics. For instance, 0% APR plans now account for 44% of GMV growth year over year, reflecting merchant demand for promotional financing. Merchant network expansion remains a cornerstone of growth. Affirm added 23% more active merchants year over year, reaching 358,000 partners. Large enterprise clients increasingly request customized 0% APR campaigns, which, while less profitable per transaction, drive customer acquisition and brand visibility. The company's API-first approach enables seamless integration with e-commerce platforms, reducing implementation friction for new partners. 3. International expansion and market diversification. Affirm is strategically expanding internationally by leveraging its partnership with Shopify to enter new markets. This collaboration grants Affirm access to Shopify's extensive network of over 1.7 million merchants, facilitating a seamless rollout of Shop Pay installments across various regions. The expansion commenced in Canada and is set to extend to the UK, Australia, and Western Europe, beginning with France, Germany, and the Netherlands. France and Germany alone represent a combined addressable GMV of potentially $120 billion, underscoring significant growth potential. Affirm's approach focuses on empowering merchants by offering transparent, flexible payment solutions that enhance consumer purchasing power and drive higher conversion rates. This international strategy not only diversifies Affirm's market presence, but also strengthens its position in the competitive BNPL landscape. Risks to consider. While Affirm presents a compelling investment opportunity, investors should be aware of potential risk. 1. Finance and corporate risks. Affirm's primary financial risks stem from its bank-dependent lending model. If regulators challenge its partnership structure used to originate loans, the company could face legal penalties, enforcement actions, or operational disruptions if forced to secure alternative banking licenses. Funding reliance on warehouse credit, securitization trusts, and forward flow agreements creates vulnerability. Failure to renew these could destabilize liquidity. Risk-sharing pacts with third-party loan buyers expose Affirm to financial liabilities if defaults exceed projections. Counterparty risks further compound these challenges, as instability among partner banks or financial institutions might impair funding access or operational continuity. Collectively, these interdependencies threaten Affirm's ability to scale sustainably while navigating regulatory scrutiny and maintaining profitability. 2. Credit and accounting risks. Affirm's allowance for credit losses is based on complex assumptions and forward-looking estimates, following accounting standards like CECL, which require recognizing expected lifetime credit losses up front. If these estimates prove inaccurate, Affirm may face losses exceeding reserves or need to increase provisions, negatively impacting financial results. The company's quarterly earnings have shown significant volatility, which can influence investor confidence and stock valuation. Additionally, maintaining robust internal controls over financial reporting is essential. Any failure could delay or impair accurate financial disclosures, damaging a firm's reputation and market value. These credit and accounting risks underscore the challenges in accurately forecasting loan performance and ensuring transparent, timely financial reporting in a dynamic economic environment. 3. Macroeconomic and market risks. A firm's business is highly sensitive to macroeconomic factors including inflation, interest rates, and consumer spending patterns. Persistent high inflation can erode consumers' purchasing power, while rising interest rates may increase borrowing costs, both potentially reducing demand for a firm's buy now, pay later and lending products. Additionally, an economic recession or slowdown could lead to higher default rates and lower loan origination volumes, adversely impacting revenue and profitability. Market volatility and trade tensions have also contributed to fluctuations in a firm's stock price, reflecting investor concerns about the company's ability to sustain growth and achieve profitability amid uncertain economic conditions. These macroeconomic and market risks highlight the vulnerability of a firm's business model to broader economic cycles and investor sentiment. Conclusion. Affirm Holdings has demonstrated significant growth and financial improvement in its Q3 full year 2025 earnings, with strong revenue increases and a return to positive EPS. The company's strategic initiatives, including product diversification, geographic expansion, and technological innovation, position it for continued success in the evolving financial services landscape. While potential risks exist, Affirm's robust performance and growth prospects make it a compelling investment opportunity for those seeking exposure to the fintech sector. But remember, this is not a financial advice. What do you think about Affirm Holdings? Are you buying, holding, or passing? Drop your thoughts in the comments below. If you found this video helpful, please make sure to like, subscribe, and hit the bell so you don't miss my next stock analysis. Thanks for watching and see you in the next one.